When's the last time you rebalanced your investment? Hopefully you know, and hopefully you have a system. Is that system where it's automatically done based on certain movements in the market or based on the calendar and what happens, what time of year it is? Hopefully you have a rebalance strategy. I'm going to show you an example of how important that is. That and more coming up. Rebalancing your investments is a double-edged sword. This is where you're originally investing based off a certain recipe, if you will. I want X% large cap US stocks, X% mid cap and small, X% international, emerging markets, X% in bonds, maybe high yield. You've got that recipe and you've aligned that recipe for your risk tolerance. And that is key, okay? That's key. But now I'll come back to it. But inevitably, it's gonna drift. Inevitably, you will have portfolio drift. Why? Because the attributes and benefits of diversification are that not all of those areas. I mean, the whole reason you have split it up and you're following a recipe as opposed to sugar. I'm making cookies, I'm making a cake, sugar, that's all I want. No, you're following a recipe because over time, each of those areas is gonna move a little bit differently. And therefore, having a smattering, having the right allocation, the right recipe is going to allow you to still have, the potential for significant returns, market-like returns, but actually taking less risk. Critical. But over time, one area, say large cap stocks recently, is going to outperform others, and pretty soon you're going to be out of balance. Do you have a consistent and unemotional rebalance strategy to snap the recipe back to the original ingredients so that you don't get taking on too much risk, more risk than you actually expected, or exposed to a seismic market event that you otherwise thought, no, I'm protected against this. Take a look at this chart. I saw this recently. This is real data just over the past, 6 or 7 years, something like that. And pretty astounding. So the 60-40 portfolio has gotten dunked on quite a bit, and by us as well. Not an enormous fan, but let's say you had a 60-40 portfolio in December of 2019, and it was allocated that way, a certain amount in large value, large growth, international, and fixed income. So this is very, very bare bones diversification. And yet they are splitting in this example, large value, large growth, because yes, those have performed very, very differently. So combining the two would be the Russell 1000, and the S&P 500 is part of that Russell 1000. But they're split out here. Okay, so that's the allocation, 60-40, December of 2019. Well, gosh, the world changed a year later. December of 2020, the market went straight down and came roaring back. And take a look there. Well, your 25% in large value is actually 23%. Your 25% large growth is now 30%. You still have 10% in international, but then your 40% fixed income is now 38%. You might say, not a big deal. I was 60-40. I'm now 62-38, and the concoction's a little bit different. I don't really care. In fact, at the time, you're probably like, I want to keep my growth stuff. Now, fast forward 1 year later. Now 26% in large value, 31% in growth, only 9% international, hasn't done as well, 34% in bonds. And you might say at that time, good, I want to have less in bonds. Even though I originally said 64, I want to have less in bonds. Stocks are roaring. We printed $1 gazillion. I love it. I'm leaving it this way. Then comes 2022. And let me just remind you that the year ended 2022 much better than where it was in October. The stock market was down about 25% in October, and then, coincidence or not, ChatGPT was released and a lot of optimism was created, and the stock market went up. November, December only finished down 19%. But at the end of 2022, 35% fixed income, 10% back international, 27% is in U.S. growth. U.S. growth, took a beating, 28% in large value. Now you can see it change in 23, 24, 25, and then at the time I'm recording this in June of 2026, this is probably as of the end of May, but your 60-40 portfolio, this is the gist. Your 60-40 portfolio is now 74-26. And again, you might say, well, good, let your winners ride, right? Rebalancing is a double-edged sword. If you don't rebalance and the thing that has been working continues to work, well, you're going to have even more appreciation, right? But if you rebalance, you're going to kind of cut off some of the gains. You're gonna sell some of what's been working and rebalance into and reinvest those dollars into some areas that haven't been working. If you happen to time it right, oh, that feels great. But if those winners kept on winning or keep on winning, well, then you just sold out some of what had momentum. And you might say right now, 74% instead of 60 in stocks, great. I should have more in stocks. I know, but let me go back to where I started. If you originally calibrated that 60-40 and you said this is the risk and reward ratio that fits for you, and I'm not saying that is dictated by you, by your financial planner. No. That fits for you. It achieves your financial goals and helps you stay on the roller coaster. Then that is what you should be resetting back to, rebalancing back to, because now 74% in stocks, even though I would say, yeah, you actually could go up to 85 or 90%. I've got 100% in stocks. You could actually do more. If we then see a drop and now you have more in stocks and therefore the drop is steeper than you expected, you're going to get off the roller coaster. You'll no longer invest for your financial goals and you'll no longer be able to achieve your financial goals because you've gotten off the roller coaster. That's why it's so critical that you optimize the right allocation and then have a consistent rebalance strategy to stay with that allocation as portfolios inevitably drift. Now, the math is clear. You're just not going to like it. The math is wildly clear that yes, the benefits of rebalancing over time help you build significantly more wealth than just allowing your portfolio to drift. But there is with all of that math, with all of that research, with all of the science, there is no set, clear rebalance strategy. This is the time to do it. So you've got some leniency, you've got some flexibility in, well, how do you want to structure a rebalance strategy? There are two, and I'll tell you the one that most people use, the one that we'd recommend. The two are based on time, so a calendar trigger, or based on momentum, a kind of allocation trigger, okay? The first is time, and that is, setting it up in your 401k or with your IRA where you rebalance every quarter, every 6 months, or every year. The math, again, is very, very clear. Rebalancing is critically important. However, there's no clear winner. Monthly, quarterly, every 6 months, once a year. And so oftentimes we say at least every 6 months, but if you want to do once a year, that's fine as well. The math is not clear on that. Just having a rebalance strategy is what's critical. So I set up my 401k, it rebalances automatically on a quarterly basis. A lot of the portfolios we manage, they rebalance every 6 months. I think 1 year, every year can work as well. Now the other is based on allocation or how much it moves. And this is a little bit more sophisticated, but it's where, all right, if the original allocation was 60% in stocks, well, if we have more than a 10% move, so we get up to more than 66% in stocks, that's when we want to rebalance to trigger. Whether that happens once a year, whether it happens twice a year, whether it doesn't happen during a year at all, we're going to have it based on how much variance there is as well. We actually combine both of those. We look on a regular basis, but then also look to see, well, how much deviation is there? You don't need to have a very sophisticated rebalance system. You just need to have a system, and it needs to be unemotional. Either one of those approaches can work. Make sure that you have a rebalance strategy that's unemotional so that you can fight against portfolio drift and the risk that's associated with it. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.